Good afternoon, everybody, and happy Thanksgiving. This afternoon's lecture covers the Federal Reserve. The Federal Reserve is our central bank. In the U.S., the Fed cannot act without considering the environment. The Fed has three main purposes. The first is to help achieve stable prices through maintaining low inflation. The second is to reach full employment, and typically that's defined as having an unemployment rate of 5% or less. And the Fed is also marshaled with achieving economic growth. The Fed typically strives to achieve economic growth of 2 to 3% per quarter. So the Fed executes what's called monetary policy by changing the supply of money and credit to achieve these goals. What the Fed does is if the economy is really slow like it's been for the past several years, it follows easy monetary policy by increasing the supply of money and loosening credit. If the Fed is really booming and piping hot, the Fed will engage in contractionary or tight monetary policy by reducing the supply of money and tightening the credit markets via the increasing of interest rates, and we'll discuss this further. Fed in executing monetary policy has several tools. The primary one is called open market operations. The secondary tools are the discount rate and reserve requirements. The Fed will use these tools to expand or contract the supply of money in order to pursue the economic goals of prosperity with full employment and stable prices in the United States. As mentioned a moment ago, the Fed will follow easy policy, easy monetary policy, when the Fed seeks to expand the supply of money and credit to spur economic growth. That's the type of policy that's been manifested for the past 7 or 8 years during the Great Recession we've kind of been experiencing. The other type of monetary policy at the other extreme would be a tight monetary policy. We last really saw this in the 1990s when the economy was piping hot, unemployment was really low. Tons of jobs out there. The concern in that type of booming economy is that with money flowing really freely, we could develop high inflation, which could be really detrimental to the average consumer and slow down the economy. So if the economy is piping hot and really booming, the Fed will engage in a tighter monetary policy where they aim to contract the supply of money and credit to help fight possible inflation. Other Fed tasks includes the supervisory power over deposit institutions and the clearing of checks. Believe it or not, every type of transaction that we individuals do, be it use an ATM machine, use a debit card transaction, or write a check, all the billions of them done probably every couple of days in this country get cleared through the Federal Reserve's computers. Pretty ominous thing when you think of it. The Fed serves as the depository institution for member banks, the U.S. Treasury, and foreign central banks, and it sets the guidelines for bank reserves, which are like cushions that banks hold just in case depositors come knocking on their door to get some of their deposit money back. The structure of the Fed involves the Board of Governors, which controls the power of the Fed. The board has 7 members, all appointed by the President of the United States. The current chairman of the Fed is Ben Bernanke. He is being replaced by Janet Yellen, who I believe will be the first female chairman of the Fed. The appointments for the Board of Governors are for 14 years, and the terms are staggered so that each governor's appointment expires every other 2 years. That way, the intent is to prevent the president from having undue control over the Federal Reserve Agency. It was set up originally to be an independent agency separate from the executive or presidential branch, and that's why we've got that staggering of appointments. The country is divided into 12 geographic districts with a Federal Reserve Bank in each district. They are set up from coast to coast, from Boston to San Francisco. Each of these district banks is managed by 9 directors, 3 of whom are appointed by the Board of Governors. The other 6 directors are elected locally by the member banks, and they represent the member banks, industry, commerce, and regulations. So the Fed tries to maintain some central control by basically instituting 30% of these governors, if you will, 33%. The other 66% or 6 directors are basically elected regionally. Member banks constitute the next component of the Fed. The member banks are required to invest capital in their district's Federal Reserve Bank. In return for this investment, the member banks receive a modest return on their capital from the earnings of the Fed. So here we're talking about these member banks taking a chunk of their depositors' money, ranging from 20 to 40%, and actually investing it in their district's Federal Reserve Bank. That way, it gives the Federal Reserve, the main bank, and the district bank some comfort that all these thousands of local member banks are actually behaving. They're not lending all of their depositors' money out for high interest rates loans. They are, in fact, maintaining a 20 to 40% cushion called reserves, just in case depositors come knocking on the door trying to get some of their deposit money back. Remember, when you make a deposit in the bank, it's referred to as a demand deposit, meaning at your demand, you should be able to go to the bank and get your money back at any time you want. And that's why, one reason why the Federal Reserve does mandate these reserve requirements. The Fed Open Market Committee is the most powerful tool of the Fed. It has control over market operations. Folks, market operations are pretty straightforward. It entails the Fed either buying or selling enormous amounts of securities from the economy. For the past several years, the Fed has participated in an expansionary type of open market operation policy where it's been buying billions of dollars of mortgage-backed securities every month in an attempt to inject cash in the economy and further stimulate growth in our economy. The Fed Open Market Committee consists of the 7 members of the Board of Governors and 5 presidents of the district banks. Because New York is really the money center of the U.S., the president of the New York Fed is a permanent member, while the 4 remaining positions rotate among the district bank presidents. Reserves, as we've been mentioning, are a portion of deposit funds that banks must keep on hand as a cushion in the event depositors come knocking at the door to withdraw some of their money. A couple of the key interest rates the Federal Reserve utilizes include the federal funds rate. That is the interest rate that a geographically located district bank would charge to another district bank for a loan. For instance, if the Federal Reserve Bank of Boston were to make an overnight loan of reserves to the Federal Reserve of San Francisco, the Boston Fed would charge the Fed funds rate of interest to the San Francisco Fed for that loan. In a similar vein, the discount rate, that's the rate of interest that the central bank itself, the Fed, would charge any of the district banks for any direct loans of reserves. So if the Federal Reserve Bank makes a loan to the Federal Reserve of Chicago, it would charge the Chicago Bank the discount rate. And because the Fed has been really focusing on an expansionary, easy monetary policy for the past several years, trying to stimulate our economy back to continued steady growth, the discount rate has been lowered to an extremely historical low rate in an attempt to expand the economy. So the tools of the Fed include the reserve requirement, the discount rate, and a targeted federal funds rate, and the primary tool is the open market operations. Fiscal policy is another type of policy you may have heard of. It's really a separate animal, if you will, from monetary policy. When you think of fiscal policy, you should think of the executive branch of government. Some of you may have been noticing when driving around this past summer, you've been running into a lot of highway or bridge construction projects in your state. Well, that's reflective of fiscal policy implemented by President Obama to try to stimulate jobs and growth in the economy. It's basically represented by taxing and spending by the federal government. As you may have heard, if you've been following the economic news, the fiscal policy hasn't been working too well in the U.S. for the past several years. It's widely publicized that the U.S. government has an enormous $17 trillion budget deficit. Essentially, the federal government is living beyond its means. A lot of things are contributing to that. The Great Recession, the two wars we had in the Middle East cost a lot of money, and some folks say some of the entitlement spending has gotten out of hand. And that's a big concern in the economy where most outsiders agree the federal government has to somehow get that deficit under control, either by cutting spending or increasing receipts. Most experts agree the way the deficit is going to be addressed is when the economy gets to be growing at a very good clip. It's really booming, and the sales tax receipts, or the sales revenue going into the federal government coffers, can help to overcome some of that deficit, but it could take some time for that to happen. A surplus occurs when the federal government receipts exceed the disbursements. We last had a surplus, federal government did in this country, in the 1990s. Inflation is a general increase in prices with special emphasis on increases in consumer prices. Deflation is a general decline in prices. How does the Federal Reserve measure inflation? You'd be surprised at how simple it is. They send a typical consumer like you or I to a supermarket. They ask us to buy a typical basket of goods. It could be milk, eggs, bread, orange juice, etc., and to get a price for that basket. And then they ask us to do it again, to do an identical purchase of the same typical basket of goods month after month. And each month's tally for that basket of goods is compared to the prior month to figure out what's the increase in inflation, the increase in the general prices of goods in the U.S. So it's a pretty simple process the Fed uses to monitor inflation. Again, it's a big concern typically. We've had numerous other financial issues like the Wall Street crisis and other crises, the mortgage market crisis affecting us. But way back in the 1980s in this country, inflation was really high, and that itself can lead to a recession. That's why the Federal Reserve keeps trying to minimize the inflation rate. A recession, which I think most of us are probably familiar with now, technically is a period of at least 6 months during which the economy experiences increased unemployment and negative growth. Thank you again for attending the lecture today, folks. I really enjoyed it. We will see you at the next lecture.